In this chapter, we are going to see what is commonly called the Greeks, or Greek letters. The Greeks are risk indicators specific to options. Each of them capture a specific risk to which the bearer of an option is exposed. Knowing the Greeks and being able to evaluate them and to capture the relationships between them allows the option trader to immediately know if his portfolio is hedged or in what measure can its price evolve. The first of the Greeks is the delta. This is the most obvious one as it captures the evolution of the option price in function of its underlying. It is the derivative of the option price relative to the underlying price. Let's say we have a stock as an underlying with a price equal to $30. We also have a call option which costs $10. We define delta as being equal to 0.2. It means that whenever the price of the stock will move of a quantity X, the price of the option will move 0.2 times X. If the price of the stock goes from 30 to 35, the price of our option will go from 10 to 11. The most basic option hedging strategy is called the delta hedging. It consists of selling delta stocks for each call option in a portfolio in order to be protected from short-term stock price variations. Why is this delta not always equal to 1? To answer this question, let's try to dissect what the delta really is. We start from the payoff of a call option at maturity. The option expires right now, so the price of the option is known. It is the payoff. It will no longer evolve, so trying to get the value of the delta at this point doesn't make any sense. Now if we go just before the expiration, a few seconds before, things are much more interesting. The price of the option at its expiration is almost certain, in particular, when the price of the underlying is far away from the strike. It's unlikely that the price of the stock will move so quickly during the few seconds remaining that it will cross the strike. So, if we draw the price of the option at this point, it is like the payoff. However, if the price of the underlying is very close from the strike, there is a strong uncertainty. The representation of the price of the option in function of the underlying will be curved. The slightest move in the underlying price could mean it crosses the strike, changing the outcome of the option expiration. Let's now draw the delta in function of the underlying price. Far below the strike, we can also say far out of the money, it is almost certain that the option will cost 0 at expiration. So the delta is very close from 0. Meaning that a move in the price of the stock has little impact on the price of the option. Far in the money now, the outcome is also certain. The option payoff will be the price of the option. So any move in the underlying price between now and the expiration will mean an equal move in the price of the option. So the delta is equal to 1. Near the strike, the delta will quickly go from 0 to 1. This confirms what we said earlier as the curve of the delta is the derivative of the curve of the option price. But most importantly, we now understand what the delta is. It is the probability that the option finishes in the money. In other terms, the probability for the buyer of the option to make a gain. For a put option, the value of the delta goes from -1 to 0. The probability that it finishes in the money is the absolute value. It also tells us something else. The value of the delta evolves in function of the underlying. It leads us to the second Greek, the gamma. That we will see in the next video.